Hi everyone, welcome to DealStreetAsia PVC Summit 2020. I'm Paramita Chatterjee and we have with us Mr. Kunal Shroff, co-founder and managing partner at ChrysCapital, which is the largest homegrown private equity firm in India. Well, Kunal doesn't really need an introduction per se. However, just to take you through a brief background, he's been with ChrysCapital ever since its inception in 1999. And given that he's been in the system for so long, he has, of course, seen a spate of investments and exits, which in a typical PE parlance is called a successful investment cycle. So welcome, Kunal, on that note.
Thanks, Paramita. Thanks for the opportunity to speak at this conference.
Sure. Thank you for being here. And in terms of ChrysCapital, it has been there for a very long time in India. It has seen the dot-com bust. Thereafter, it has also seen the global financial meltdown and now a different crisis altogether. So Kunal, on this note, will take us through the art and science of fundraising and investments in India and scoring exits in the country. So welcome once again. Yes.
Thanks,
I'll begin with the big picture question that's on everyone's mind. It's about the slowdown in the Indian economy. So on one hand, we see, figures about GDP, which are alarming. And on the other hand, we also see the RBI actually flagging off, huge inflation numbers, which don't seem signs of waning away. So what is your take on the slowdown? Is it for real? How deep is it?
Yeah. So I think, look, obviously this pandemic is out of control in certain situations, and it has, caused a lot of damage, not just economically, but lives, healthcare, variety of different factors. The downturn because of the lockdown and the slowdown as a result of that is a global phenomenon. India has had a very, very long lockdown and a pretty strict one. And while we are still in some unlock phase, a lot of the services, a lot of the activity is still not back to old levels. So it is a pretty serious economic impact. And if you look at current indicators, if you look at the last few months, September, October, clearly there have been many green shoots. You look at electricity consumption, you look at two-wheeler sales, you look at some data, and you feel, oh, okay, maybe we've turned the corner. My own view is I think it's still a little early to tell whether some of it is pent-up demand. So because you didn't consume much in April and May, you loaded up the next 4 months, right? And so while there are some green shoots, I think it'll take a little bit of time before we actually acknowledge it and say, fine, this is a sustained recovery, or that this was a one-off.
Right.
Two other points I'll make is we're still talking about massively negative GDP growth for India, right? In comparison, China is going to grow. China has really shrugged COVID off and is moving forward. We're talking about growth this year and next. India has a massive negative -10 or more this year, and then coming out of that. So it's going to take you a while to get back to pre-COVID levels as an overall economy. But individually, there are sectors that are doing much better than others, and we can talk a little bit more about that.
Sure. Thanks so much. In fact, you spoke about the challenges. But, sans the challenges, do you still feel that India is one of the countries that poses great opportunities for foreign firms to come in, or even sovereign funds? We have seen the case of Reliance. PE has really done well there. In terms of the VC funding, we have also seen digitally backed businesses, which have evinced significant investor interest. So what's your take on that?
Yeah. No, I think, look, we are paid to invest in India. So obviously I'm going to be a little biased here. But overall, I think India always has potential and it has demonstrated it. Maybe it's not been as widespread as it was, as it has been in the recent years. Maybe it's been harder in the past. I think maturity has come into the landscape as well. And I think over time, you will see the PE industry also mature to a level where, the types of deals that you consider traditional private equity and buyouts, you'll see more of over time. Sectors will change. I mean, yes, there was a lot of interest in the Reliance deal. There is a lot of interest in certain new economy sectors. We've seen that play out in the past also. So I think sectors will move up and down, but the potential is definitely there. And it's not just about the size of the population or the potential middle class in India, but it has to do with where we are in the penetration of certain goods and services. And is there potential? Is there a framework to harness that? Now, there are some other trends at play as well, which is it being harnessed by the multinationals, or is it going to be harnessed by the locals? And there is some interplay there. There's some politics going on around that as well. But overall, I think the opportunity set, if you have a long enough view, is quite strong.
Right. You mentioned a very interesting point here about buyouts. So do you think in the wake of the COVID-19 crisis, there is significant opportunity for investors to clock distressed deals, or even for that matter, buyout deals?
So I think still this COVID crisis and the impact is still, it's too early to judge. And I, don't know if it will necessarily help you strike the deal. What it is doing is, in certain sectors, the crisis is pressuring entrepreneurs to look for avenues that they didn't think of earlier in the opportunity set, right? Now, if we look at it from ChrysCapital or even traditional private equity firms in India, where have they deployed a lot of their capital? I think historically it used to go in all sectors everywhere. The question was, where can I deploy large dollars, and money would flow in. And I think I'm talking about 10 years ago. And I think 10 years ago, a lot of capital went into sectors that didn't have good return on capital characteristics. And therefore, entrepreneurs ended up taking the money, but not delivering a good return. And GPs ended up giving the money, but not making a good return for their LPs, right? I think a lot more sophistication has come in, a lot more clarity has come in. So if you look at where the dollars have been deployed in the last, let's say 5 years or last 3 years, a lot more of the dollars have gone into sectors with better quality management, better return on capital characteristics. And what are these sectors? There are sectors like IT services, financial services, pharmaceuticals, healthcare, new economy in certain areas, where new economy obviously has been higher risk takers. But by and large, these are sectors that have generated, and consumer, of course, have generated good return on capital. And therefore, the ability to compound value and generate that is there. Now, in these sectors, COVID impact is very different, right? So, we thought there would be a bigger impact across the economy, but that's not been the case. Pharma healthcare has actually been, not as affected by it, pharma particularly. IT services had a tough June quarter, but, if you look ahead, any of these changes where lots and lots of companies world over are moving into partial work from home, leveraging technology, they're going to invest more in technology. So some of these sectors ended up benefiting. New economy, we've seen what's happened with the banks. I mean, they ended up actually benefiting as people sat at home and consumed media, products, everything from home. So it's a disproportionate impact. And then when you go to those companies and say, give me a distressed deal, they're going to say, what distressed deal? We are not in distress. Whereas if you're in other sectors, whether it's travel, whether it's hospitality, whether it's restaurants, yes, there is distress there. But then the question is, are they willing to transact, and is the buyer willing to transact? So, it used to be a very haves and have-nots economy even before COVID. And I think COVID has exacerbated that.
Right, absolutely. Now, talking about the crisis once again, ChrysCapital was there during the last crisis as well, during 2008, 2009. And if I remember correctly, 2010 was the year when it made headlines, when it returned about 300 million capital to its LPs from its fifth fund, which had a corpus of over 1 billion. So how different is the crisis now when you compare it to the period of 2008, 2009 slowdown?
Yeah. I think it's different. I think this time India is more affected than last time, actually. Last time it kind of passed us by. But this time there are sectors, there are jobs at stake. Job creation was a problem pre-COVID. It's becoming worse with this issue. If you think about, you mentioned ChrysCapital return capital. See, our philosophy is how much can you invest in a year? And it's a 10-year fund life. So you're trying to invest the fund in the first 5 years. And so if you have at that time, it was $1.25 billion, which was our fund size, right? Are you able to deploy $250 to $300 million a year? And if you're not, then you got to right size the fund. So I think the reason for us to do that in 2010 was we were seeing the opportunity set for us not as attractive, where we would consistently deploy that, right? The world had changed. And then we said, look, what is the pace at which we can deploy? And if that is the pace that we have, then the excess capital shouldn't be a drag on our returns. So we ended up returning that capital. and focusing our energies on where we thought the risk reward was good. And ultimately, it ended up serving Fund 5 investors well, right? This time around, when we look at the scenario, our fund size is actually slightly smaller than where Fund 5 was 10 years ago, right? And the opportunity set actually has expanded pretty significantly, even before COVID. So even now, when we look at it, we just completed 1 year of the fund, and we've invested about a quarter of the fund. And when we look at the deal pipeline, we could keep pace at that level, which is a 4-year investment cycle, right? So on that basis, you feel pretty confident. And if things were to pick up because of COVID, then you can actually deploy it even sooner than the 4-year pace. So I think the crisis is actually worse, but because of the massive consolidation that India has seen in terms of the local funds and the funds that operate in the, let's say, the 100 million or 200 million and below range, we think the opportunity set has not shrunk. The opportunity set is actually wider.
Right. Right. So I actually, since we are talking about the fundraising bit, so you closed the 850 million fund early last year, and you said you have actually deployed about a fourth of that capital so far. So the core sectors that ChrysCapital has always looked at are financial services, healthcare, business services, and consumer. It has completely been missing from the new economy sectors like the internet or the digitally viable businesses. Why is that? Is that a conscious move? Do you want to foray in that segment? What is your plan there?
Yeah, no, that's a fair question. I think the 4 sectors you mentioned continue to be our active sectors, right? And we'll continue to look for opportunities there. In the last 3 years, we've spent a lot of time on new economy, and it's just too important for us to ignore it. We just haven't ended up deploying a lot of capital. But in a way, it's true even in consumer. We've been looking at consumer very, very seriously for over a decade now, but we don't have a lot of dollars to show for it, right? It can be for various reasons. You couldn't find enough deal opportunities that made it past investment committee, or you were outbid because others were willing to pay up, n number of reasons, right? And we don't like to judge our team or our performance even in shorter periods. It's better off looking at it at a longer period and saying, okay, fine, was it a miss because we couldn't judge the growth potential, or we didn't pay up for it? What are those, right? And those lessons are learned over a much longer period of time. On new economy, our view is that we are generally not going to spray and pray, right? We don't want to have a large portfolio of companies where you're taking a bet and hoping one of them becomes a Google, right? That's not the model for us. We are looking to make doubles and triples on each investment. And in new economy, maybe the risk is higher, the reward has to be higher. But we don't expect to make 100x's. We're not coming in that early at the risk stage, right? So we want to come in where there is some proof of concept already in place, path to profitability already in place, unit economics that are profitable. Now, when you put all those filters on, it reduces your opportunity set. The good news is, even after putting those filters on, many companies are now making the cut, right? Which may not have been the case 5 years ago because you were still early in the cycle. So we are pretty excited about what the new economy over the next 5 years can offer in terms of our deployment pace. We've recently made a couple of investments in the space and clearly are looking to do more. We're in diligence on a couple of opportunities as well. So our view is, it's not going to be a venture approach. It's going to be a private equity approach. We're going to look for companies that are understandable versus some moonshot that can end up, delivering an entire fund. And then potentially you have to pay up for it, right? Because the company has already proven a certain amount. And then you believe that the potential is still there because India is still early in that curve, and then you pay up for it. So I think that has been the approach in the last couple of years for us.
Sure. So talking about the new economy sector, I think 2 investments in the startup space that have been done from ChrysCapital side. One is Office and the other one is Dream Sports. So which are the kind of deals are you scouting for? Because typically this space is targeted by VCs. So we see a lot of Ps and VCs compete with each other when it comes to this space now. So how do you tackle that, and what is your view?
Yeah. So I think we may come a stage after them. We are not doing Series A, Series B typically. Although, we're not averse to it. We're not looking at it from the Alphabet standpoint. We're looking at it from a company standpoint. So if you're a company that is already profitable, and now because of corporate overheads, your EBITDA is negative, and we have a part to see, look, with X amount of growth at the same margin, I'm getting to profitability, it would be something we would look at. And why are we focused on profitability? And I should say sustainable profitability, because there are enough examples where they become profitable, then they again, to gain market share, lose money and come back. And so we are a little careful on that. But if you have sustainable profitability, then you're not dependent on the capital raising cycle to be a going concern. And we don't want to be the one that has to constantly put money in to keep a company alive, right? Because that's not the game we are playing. So we're going to play at a much later stage than when a typical VC will enter. And now for that, we may have to pay up. You're not going to get any cheap deals. But that's fine, because it's not just about doing the deal, right? Doing the deal is the first part. Then you have to work with the company and help them get to a certain point. And I think we're not suited to just invest in a business plan and help them. We are much more suited when the company is at profitability, on the cusp of profitability, and then we are helping them, streamline the costs or expand the management team or expand the market side and eventually take them public. So I think each fund will have to look at it from that perspective. So for us, we're looking at it two ways. We're saying Dream Sports you gave as an example. That's, a unicorn and more than that, right? Now we've tracked the company in the past, and we looked at it pre-COVID, and obviously COVID hit, and we said, well, sports, COVID, it's going to have a tough time. And actually what ended up happening is, even though globally sports were down, folks were still engaging with the platform, right? And so for them, the June quarter, which should have been a terrible quarter, was actually a strong quarter. And that showed the resilience of the business model, which gave us and a bunch of other co-investors the confidence to say, this is a company worth paying up for, right? So if a similar model comes in where you've got profitable economics, market share that's defensible, and the ability to grow, multifold from the current base, the only thing holding that back is going to be how much you have to pay to play that, right? Sure. And that is something that we are willing to adjust given the kind of growth potential. On the other end, it could be a really small company, but in a niche. That niche is defensible even if there are larger players out there, because they're not focused on the niche, and it's profitable. So you will continue to grow below the radar. So we are looking at both sides of the new economy on that front, but not the ones that are losing money to gain market share. That's not for us.
Sure, got it. So you briefly touched about the themes that have emerged from the pandemic. Taking that forward, what have been the key learnings for risk capital industry as a whole during the last few months?
Yeah, I think the biggest learning we've seen is how companies and people have adapted to this, right? I mean, apart from the sort of the pandemic and all the challenges that various people face, one of our big concerns going into the pandemic is, how is the portfolio and how can we support them? So we even created kind of a nerve center for any of the portfolio companies to call in, had a consulting firm work with us to really triage for any firefighting solutions, right? And we said, let's brace ourselves for a difficult June. Let's just see, because our portfolio is not leveraged that much. You don't have the problem of interest payments and bankruptcies or any of that stuff, right? And that'll be the case for most funds in India. But we were nervous, saying, look, if a company can't operate itself, can't open their stores, what's going to happen? And what has surprised us is the June performance, even the September performance as a whole has been really good, because companies really variabilized their cost structure, figured out how to streamline certain things. They benefited because they didn't have to spend on marketing. So there are some of those things, but more companies surprised us than not on the positive, right? And the ones that were in the good sectors ended up doing well regardless. But even the ones that were in trickier sectors ended up navigating that well. So that was one. Two was, we thought that we will get the point you made, distressed deals. We thought we'll get cheap deals. We thought there'll be some attractive opportunities. There'll be some desperate sellers. That didn't happen. It turned way quicker than I would have expected, as well as my peers, because I spoke to a lot of them, and everybody was hoping to do COVID discount deals in the June quarter, and that window was too short. Now, I think some of that is a global phenomenon also. When you see where the market indices are globally and how they bounce back from the lows, it really shows how much capital there is, right? And I think that is a bit of a challenge because you just have no pressure on performance. People are already looking beyond the COVID year into the next year, giving benefit of doubt to the companies. So I think the big challenge is going to be valuations, which may remain high, even though performance may not pick up as expected. So if you see a faltering of the recovery, I don't know if you'll see a massive commensurate correction in the valuations because, given interest rates and where things are, people may still kind of kick that can down the road and say, okay, let's project another year ahead.
Sure, absolutely. That's actually food for thought indeed. So on that note, you spoke about how the contours of deal making has also changed. Now, initially, if we see the business, the business of PE and VC, it's people linked in the sense that there are in-person meetings wherein an LP decides where to park the money, which GP to park the money, and GPs in turn park their capital in businesses again through in-person meetings. Now that's completely gone or not happening. So how do you see a relationship-based evaluation to pure, return-based assessment, so to speak? What's your take on that?
Again, I think everybody will adapt, and they are adapting. But the question is, how long does this last? There have been other pandemics in the past. There have been other issues in the past, and they do blow over at some point. They will cause their damage, of course, right? So the question is it permanently changed? Is it partially permanently changed? And do some things come back, right? So I would still expect that at the end of the day, relationship will be important, but you will have to adapt. You will have to ask yourself, okay, am I going to wait until all the dust settles down and not deploy at all until then? Or how do I think about it? Which are the companies affected? Which are the sectors affected? Where do I want to be a wait and watch? And where do I want to be aggressive? Right? Because at the same time, this year has offered interesting investment opportunities, right? And you don't want to just be completely gun shy and avoid those. So I think what most of us will do is say, okay, let's go after the known devil. If we can put more money behind our portfolio companies that we already know and have a relationship with, that's the first step. Second is, if it's a sector we know extremely well, and through our sector network, we've been tracking this company for a long period of time, that builds confidence, right? So you're going to go after the known devils and potentially pay up for the known devils, right? Then comes the point about, okay, complete blue sky. I really haven't thought about entering ABC sector. How do I go about prospecting? I think that takes a little bit of a backseat because you're not going to just go around, let's say real estate. We don't invest in real estate. And at some point, if somebody woke up and said, let's invest in real estate, not that we're going to, very hard to do, right? How are you going to go about randomly meeting 50 companies in this environment to really only for prospecting purposes? So I think some of these things will be sequenced, saying, look, sequentially, let's go down this path. But ultimately, you have to realize, even for the entrepreneur, it's going to be, okay, who am I partnering with? And I think that becomes even more critical in this environment when you're not able to meet the person very frequently, to say, am I bringing on somebody on my board who I don't even know that well, who can then affect my trajectory? Right. And I think, therefore, the ref checking vis-a-vis the entrepreneur community on a PE fund will become more important, right? Saying, okay, let me talk to other funds, other companies that have taken money from this fund. And how has their experience been? So just the way we may have our hesitance of going after a company, the company may worry, well, in a downturn, is my partner going to be supportive, or is my partner going to be even more painful, adding to my burdens? And so I think the people who are more on the ground, the people who have kind of covered and built those relationships beforehand, can actually encash some of that currently. But over time, I think even that advantage, if you will, that someone like us with 20 years on the ground has, will diminish because everybody will adapt and figure it out. And you can derive that confidence from other proxies, saying what are competitors talking about this company, what can we bring to the table. So I would imagine that if this will not meaningfully affect the trajectory of private equity. I mean, we can see it even now in terms of dollars deployed. June was a quiet quarter, but September was a very, very busy quarter. And even now in our portfolio, we are looking at, in our deal pipeline and our portfolio, we're looking at doing deals where, you're managing virtually for the most part, and then doing a few things physically, right? So similarly, I think everybody will adapt to this model and take it forward.
Right. So it's safe in that regard to say that private equity investors are actually still taking a cautious approach towards fresh capital, deployment of fresh capital in businesses, right?
Yeah, I would say they are taking a cautious, but they're doing a calibrated approach. So I think in sectors where they have had success, they are being aggressive. In sectors that are newer to them, uh, they're being they're prioritizing and saying, look, might as well back the existing known name. And that's where I think someone like ChrysCapital, who's been on the ground longer, has covered sectors longer, has a little bit of a leg up because our funnel is wider to begin with versus just meeting a company for the first time in a memo that comes to you.
Right. So what's your take on the exit environment in India? Paucity of exits has been plaguing LPs and investors for a while now.
Yeah. So I think it is going to improve. I think the numbers are already much bigger than what they were 10 years ago. And I think that's also because the dollars are being deployed in sectors that are compounding well. So I think, in the past, it used to be said to us that, hey, ChrysCapital, your exit track record is very good. And that used to be a differentiator. And even now it is, just because of the volume of exits we've done, right? And the number of funds we've successfully closed out. But I think you will see more funds doing that. So if you look at us, we're on Fund 8 right now. We have 5 funds fully closed out. Fund 6 that has returned capital back to investors. So there's only profits. And it's very good to have such a low legacy portfolio. But I think you'll see that over time that more investors are delivering dollars back. And the other thing is, as the larger funds get larger and larger, the global ones, their ticket size is going to keep increasing. They want to do $300 million deals, $500 million deals. They could end up being exit candidates for us, right? And I think that opens up our avenue for exit. So you're not waiting for capital markets to deliver the exits that you want. So I'm quite confident that you'll see the number increasing, and hopefully LPs start warming up as a result of that.
Sure, that's actually heartening to hear. So before we wind up, two big picture questions for you. What will be the impact of the India-China standoff on investments in the country? And, on that note itself, do you think India Inc. Can afford to have a standoff with China as such?
So I think that's a good question. I think sort of global trade has been on the wane for the last 10 years, right? Even from the global financial crisis onwards, where protection barriers and all globally have been erected. And I think that overall hurts a country like India that needs exports and other things to prosper, given the size and stage where we are. Overall, look, China is way bigger than India. And India as a proportion of Chinese trade is 1-2%. Right? So without India, China can continue to, do what they're doing. For us, China is still a bigger percentage, right? It'll be 5-6% of trade for us. And so obviously the impact of China on India is more than the impact of India on China. And therefore, I think it's in everybody's economic interest to make these things work. So there will be political distractions and there will be the economics at the end of the day. The bigger issue that everybody talks about is US-China, right? And if the US is looking for de-risking or finding second source, which are the countries that benefit from it? I think India has done a poor job of capturing that. One is our mix is different from what China exports, so it's not easy for us to step in. But two is, this is a story we keep hearing, but India has really not delivered anywhere close to potential. If you think about it, even from a currency standpoint, we were at 40 rupees to the dollar 10 years ago. We're at 70 rupees to the dollar, above that, right? That is a massive change if you really wanted to leverage that and say, I'm cost competitive, right? There are a lot more things that go into it, power costs, infra costs, red tape, whatever else. And while the government has been doing things, it's clearly not enough, right? So we have a long way to go. Even now, when you look at who are the beneficiaries, you'll hear Vietnam, you'll hear Thailand, right? Now, they're much smaller countries. Technically, India, with the size of our population, size of our economy, we should be head and shoulders above any other country that benefits from this, but we are not. So I don't think we are pivoting our investment strategy around US, China, and India as the beneficiary. But yes, I think there will be some trickle down benefit as people try to kind of balance out their exposure to China. And we will keep that in mind when we're investing. But I don't see any game-changing events in the near term on that.
Right. So what are your predictions for 2021?
Prediction.
That's my last question.
It's always dangerous to predict. It tells you more about the person making the prediction than actually the prediction. But I think my worry is that the recovery is going to be lopsided and it's going to have, problems. There'll be obstacles in the recovery. And at the same time, I think valuations are not going to slow down because of, extra quantitative easing, if you will, extra liquidity in the system. So you're going to have this weird scenario where low growth, low prospects, but high valuations. And I think that's what's going to have to be navigated next year.
Right. So thank you so much, Kunal, for being with us and sparing time to do this chat. Really, really appreciate.
Sure.
So thanks all of you for watching.
Thank you, everyone. Thanks, Paramita. Really enjoyed the conversation. All the best to DealStreetAsia.
Thank you so much.
Bye-bye.